I've never seen silver price top when the gold-silver ratio was at 80-1. We run a full-service depository. We store about $1.2 billion in assets.
Tell us about your hedge fund.
It's about $190 million in assets that I manage.
If I invest in your fund, what does my statement look like?
It's the only fund in the world, physical metals fund, that is tied, that's an insured party on the all-risk policy of the depository.
What is potentially going on with the SLV options expiration coming up?
If Nvidia earnings miss and we break below support, it's lights out.
What's happening, good people? We are here to record Macro Dirt Podcast number 73 with my man Jared Dillian and special guest Bob Coleman. How you doing today, Bob?
Good. How you doing?
I'm good. How you doing, JD?
I'm doing great.
Good, man.
I'm having a good hair day.
You are.
Yeah.
You do look good, and I like the blazer and the soft sash around your neck. That looks nice. But we have to go over this because it's Macro Dirt Podcast number 73. If you're browsing around the NHL and you see number 73 in the Bruins uniform, you know we are talking about phenom defenseman Charlie McAvoy. Now, if you're riding around my hometown and you see the word McAvoy, it's probably on the side of a plumbing truck because his family runs the biggest and best plumbing business in my hometown. But Charlie McAvoy was the 14th overall pick by the Boston Bruins in the 2016 NHL draft. He was at Boston University in the NCAA, and across 2 seasons, 75 games, he amassed 51 points as a defenseman, right? Helped lead BU to the tournament twice. Yeah, then, listen to this. In April of 2017, McAvoy signs a 3-year entry-level contract for $4 million, right? He makes his NHL debut at 19 years old, 2 days after the BU playoffs end, in the NHL against the Ottawa Senators in the playoffs, standing next to Zdeno Chara, starting the game on defense. Right? He logs this team's second highest ice time in their 2-1 victory, and he just signed an 8-year, $76 million extension in October of 2021. That's a pretty solid NHL career so far for the young man, wouldn't you say?
That's $8 million. What is it? 8 years, $76 million.
Yeah.
Yeah, that's pretty good.
That's pretty fat, and he's all of like 22 years old.
Yeah.
Right now. So I think he's set up for success. Bob, let's talk about you right now. Tell us where you're coming from. Tell us tell us about the arc of your career, and tell us about your expertise in precious metals today. We are going to tear you apart in this podcast.
Sure. Well, that's probably one of the best intros to a numbered podcast I've ever heard. So
Awesome. We're trying our best here.
Sure. Yeah, I'm coming from our depository here in a city called Nampa, Idaho, which actually is the second largest city in Idaho that probably no one's ever heard. Mm-hmm. But yeah, we run a full service depository. We store about $1.2 billion in assets. I also run a hedge fund in precious metals. It's all physical metal held outside the facility. So. And then we also are involved with buying and selling metals, not only to retail, but high net worth, ultra high net worth. We do logistics, not only here in the U.S., but around the world, fully insured. We have the fully insured armored trucks as well. So we do a lot of stuff when it comes to metals, kind of touch all facets of it. And that's one of the reasons why I think a lot of people follow me around the world is it's not just a dealer promoting, the end of the world or the end of the dollar, but I look at more of the market structure, things like that. Because I've been in the business since 1992. Started my career with Dean Witter back in, I think, actually early '93, actually, and then have just been following the markets ever since.
What were you doing for Dean Witter? What capacity did you start with them?
More on the advisory side. But I kind of did a lot of different things. Back in the early '90s when you still had Quotron machines, you were actually still trading stocks, and we had the commodities broker with all the Ibison charts plastered all over the walls and things like that. So yeah, you get a chance. I did a lot of sort of block trading where we called right to the desk, to the New York floor, or so, a lot different environment, obviously, than we are today, where everything's point and click. But it kind of gave you, an opportunity to talk to a lot of veterans. Phil Roth, as a technical strategist, one of the best in the industry. I mean, just a lot of great depth over there, and you learned a lot.
Yeah. Yeah, that is a breeding ground for a good education for sure. Tell us about your hedge fund. What's it called? And it is all about investing in physical metal?
Yeah, the focus is physical metal. It's dollars and cents growth fund. It's about $185, $190 million in assets that I manage. Basically the structure is about 74% physical silver, about 24% physical gold, and about 2-3% physical platinum, which I added back in March in early April this year. So kind of nailed that bottom right in the 900s. But again, it's really tinged for longer term type of investing. So, when you own physical metal, you don't and it's all paid for in cash. There's no leverage. I don't hedge. So it's allowed me to take full advantage of this market movement this year. But it's designed to actually, because part of what I've done, I started the depository business back in 2008, and I was looking at the metals. About 2006 is when I started looking at the melt up of the markets and everything. I was like, this is not going to end well. You got to have something outside the financial system as a financial asset. Gold and silver made the most sense because it has 5,000 years of history. Bitcoin wasn't around then. So what I looked at was counterparty and systemic risk, and owning physical metal directly or having a direct relationship with a depository made the most sense to me as a finance guy. So I basically started my own depository. What I noticed in the industry, and it's still true today, I think I'm the only depository in the country that is not owned by or associated with a gold dealer, financial institution, or a cash in transit company. So I'm not predicated on transactional business, whereas that's how most other depositories are set up. They're sort of a carrot for their parent company to grab the transactional markups and things like that sort of feed their transactional revenue. So I looked at this more of reducing conflict of interest. I looked at so many risks as an advisor and so forth. And when you have a fiduciary responsibility, you kind of have to use risk management first, and then build a business around that. So removing going concern risk and everything that could come when you have a downturn in the market, or the economy drops out of bed, or the markets crash, whatever it may be, and transactional volume starts to dry up rather sharply, which happens in the metals industries quite a bit. There's a cycle that it follows. When people are storing metals, that has no impact whatsoever to the operational side of buying and selling metals.
I got a question. So you said like 70-something% silver and 20-something% gold. Most people usually have that the other way around. Why the big allocation to silver?
Yeah, I started to whip the other direction. Prior to 2020, it was heavily weighted to gold. Then all of a sudden, by 2020, you had the gold-silver ratio blow out to 125 to 1. So I started selling gold back then, buying silver due to the ratios. And now you're still about 79, 80 to 1 right now. So a lot of people say, well, didn't silver just top, in October, it broke out, new all-time high, and then it pulled back. You got a double top that just created on the daily charts. And I've learned to keep it really simple. I've kind of lived by a motto: if you can't write the idea on the back of a business card, it's not worth investing in. And if you look at silver, I've never seen silver price top when the gold silver ratio was at 80 to 1. Typically silver will get down to 30 to 1, or even lower than that when you get that ultimate spike in silver and you get that sort of crescendo top. I don't think we've seen that yet.
Very interesting. If I invest in your fund, what does my statement look like? Does it look like I just own 70% of silver and 20% or 30% of gold, and that's the value of it, and I am tied to actual physical? Is that thinking about it the right way?
Yeah, it's. I mean, it's a typical Reg D Section 506 offering. So it's your typical hedge fund. You get a statement, just shows the value. I give the portfolio makeup. I do a monthly newsletter for investment clients. And I give a sort of a breakdown of the percentage structure that's supporting or invested in the fund. But it's unique because the fund actually can not only make distributions in cash or in physical metal, because the metals, I don't really play the game of, hey, I only buy 1,000-ounce silver bars and 400-ounce gold bars. I own gold, nothing larger than a kilobar and as small as a gram. On the silver side, we own 1,000-ounce bars, but we also own silver as small as junk coin. So I can provide delivery. I can provide delivery in already owned small form, which is in certain instances, especially when you get tightness in the market, especially with different products. I don't have to then send out 1,000-ounce bars, go to a refiner or a minter and say, hey, listen, can you convert this into 1-ounce rounds and pay an upcharge and that type of thing. So it allows a lot more flexibility. It's the only fund in the world, physical metals fund, that is tied, that's an insured party on the all risk policy of the depository. No other fund, trust, closed-end fund, ETF can make that statement. And
break
so
that down. Can you break that down for me again? I just want to go over that a little bit slower, both for myself and for our listeners, because that sounds really like a really important factor about your fund.
Yeah, it's about risk management. So most funds out there, or ETFs, closed-end funds, trusts, things like that, simply take that. They have a relationship. They go to a third party like Branks or Royal Canadian Mint, whatever it may be, and they park their metal there, and they use that name for credibility and sort of the prominence of those companies. But they're not. They rely on the depository and their operations to determine, okay, am I fully insured? What kind of insurance policy do they have? What does it cover? What are the exclusions? They have no oversight with that. They simply just have to go to the depository and they kind of rely on the depository's discretion of, okay, how much do I want to insure? Because in this industry, it's very common to underinsure your exposure and at the same time have very high deductibles to lower that insurance premium, because the insurance premium is one of the biggest costs of a depository. And by doing that, you start to if you're underinsuring your exposure or have very high deductibles, all of a sudden any losses could become catastrophic or crimp the going concern of that depository. So I looked at all that back in 06, 07, 08, and I was like, well, the only way to thwart that is to open up my own depository. And you've had instances like First State Depository out in Delaware in 2022. They got shut down by the CFTC. I think it's about $115 million in losses, where basically it was a depository owned by a parent company or owned by an individual who also owned a gold dealership and was basically siphoning metals out of people's boxes for 10 years. It's the largest depository loss in U.S. history. I mean, it's just enormous. And that was so-called segregated storage. That loss has now filtered into a class action suit, bringing in a very large IRA precious metals custodian or self-directed IRA custodian that is involved with precious metals. You're starting to see the cracks in the industry as sort of these overpriced dealers, with these gold IRAs and so forth, selling very highly marked up product. As long as the prices go up, everyone thinks they're making money. But what's happening is when people go to sell, they're starting to realize, well, wait a second, I paid way too much. Or in the case of Oxford Gold Group in California, that was a gold dealer that was taking in money, never bought metal at all, and basically or allegedly pocketed the money, and the clients own nothing. So now those clients are going after another very, very large IRA custodian in a class action suit there as well. And so there are a lot of landmines that people need to sort of be aware of when they're buying metals. How they store it, how they hold it is probably more important than why they store it or why they hold it.
Man, that's really interesting and a lot to unpack there. JD, what are you thinking about?
How much does your insurance cost? I have no. Is it 100 basis points a year, 200? Like what is it? What does it cost?
Yeah, we can't divulge that information. Yeah, you got to be very careful because Lloyd's has, for example, we can't send out the policy outside the facility. People can come to the facility and read the policy, but there's provisions that we have to follow that doesn't necessarily put the policy in jeopardy. Sorry to beat around the bush there, but it's just something that it's one of those things you just can't talk about. But for example, our policy, we have a $10,000 deductible on a $1.2 billion policy, meaning, if $100 million got stolen tomorrow, it's not 10,000 per account, it's 10,000 period on that $100 million loss. And I do that for the sole reason of saying, listen, I don't want Idaho Armored Vaults, which is my depository, to have any potential cash flow concern. At $10,000 is extremely easy to meet versus trying to play the game of having a $250,000 deductible, or maybe like in the case with a lot of these depositories, especially with COMEX, they store billions of dollars of assets, but they may have only a $1 billion all risk policy that covers only maybe $1 billion worth of assets any given loss. And if you're storing $5, $6, $7 billion in assets and you have a major loss, people may not be fully insured to the point that they think they are. And that's, again, you're trying to reduce risk for the client that says, listen, I already bought this metals. Now I'm entrusting you to safeguard those metals. And safeguarding means not only just protecting the metals, but also the client information, as well as fully insuring and protecting the metals against any risk possible. We have risks. Our policy covers mysterious disappearance, for example, employee theft, which are typical exclusions in many all-risk policies. So when you hear the term all-risk policy, it doesn't mean it covers every risk. There are exclusions, but if you have a stellar record and so forth, it's easier to get some of these exceptions now covered or exclusions covered.
Wow. It sounds like you've got a very well thought out structure to the fund, man. Congratulations on that. You kicked a lot of tires and you saw where all the weak points were and you kind of filled them in. That was really well done. Let's talk about something that's a little bit more topical right now, Bob. I want to hear you unpack what is potentially going on with the SLV options expiration coming up. You've been tweeting about that. It looks like there could be a large creation of SLV stock if we settle above $50. Can you just unpack what's going on with that story right now and what you think it means for the silver market, please?
Yeah, I think a lot of people may not realize that the options market, and you guys probably know this is better than anybody. I mean, it's grown so much over the last couple of years in terms of structured product creation, options markets. You have Robinhood creating these sophisticated platforms where people, the normal retail guy can now do these, crazy types of strategies right from their computer. But with SLV, for example, what people may not understand is the dynamics of how the options market has come into the precious metals world. And SLV, which happens to be the iShares Silver Trust, for those that may not know the symbol, basically it's the largest silver ETF in the world. It's heavily used for indexing by institutions, for structured product vehicles, by broker dealers, creating hedging strategies, buffered notes, and all these different kind of crazy structured products. But at the same time, there is a lot of retail call and put buying that comes into the market. And as I started seeing this back in June, where you got a pattern that every option expiration week, during that week, no matter what the market was doing, if it was going up or whatever it may be, there was no share creation whatsoever. And the short selling activity started to increase during that week. And then magically, by the following Monday after expiration, all of a sudden you had a big issuance of shares created. And meaning when the authorized participant, for those that don't understand how ETFs work, when in order to create more shares for the market, the authorized participant which has, they're the ones that create and redeem shares. In order to create those baskets, they have to deliver the underlying asset to that ETF. So in the SLV's case, it's physical silver. So they have an inventory of physical silver, or they go out and get the silver, they deliver it to the ETF, and then the ETF issues shares to the authorized participant. Well, if you're increasing short selling activity as a market maker, for example, and this is, again, all alleged, this is just simply looking at numbers. You can't determine intent by just watching numbers. But if you look at the short selling activity that's happening, typically this is naked selling, usually under Reg Show, allowing market makers to naked short in order to create an orderly market. Well, if the selling activity is really picking up to a point where it's consistent every single option expiration week since June, as the prices have been rising, you could maybe make a case that, hey, wait a second, they're potentially hampering the silver price or the operations of SLV and the silver market itself by meeting that demand for buying, whether it's call buying or buying of shares by the public, and meeting that demand by actually shorting shares that they don't have into the market. And another impact with the options market is a term called gamma squeeze, which typically happens when dealers who are short calls, the public buys calls, the dealer sells those calls to the public. They go ahead and hedge with maybe a portion of underlying, because knowing that, hey, listen, most calls expire worthless. I don't need to go one-to-one relationship on a hedging strategy. I just need to have a certain amount to hedge. And then all of a sudden it's all math. They're looking at the probabilities of potentially those calls being exercised, going in the money and so forth. Well, the gamma squeeze, which was very evident in October, is a situation where volatility starts to rise on the option premium, as well as the price is going higher at the same time. And in the metals markets, we have a very interesting dynamic with volatility and price action. Typically when volatility goes up in the S&P 500, that usually means, hey, listen, the market's going down. Well, in the metals market, since about 2022, 2023, when volatility rises, the prices are rising at the same time. So when you're a dealer who's short calls, and all of a sudden the price is going up, as well as the volatility premium is going up, meaning that the call option is actually accelerating higher in value due to the volatility premium. And the intrinsic value, they have to go out and buy more underlying shares to hedge, because at some point, if those options become in the money, they run the risk of that call buyer exercising those calls and wanting to take delivery of the underlying.
So then you're leaving the dealer short potentially. So that's why you're saying the dealer has to cover something. But what I don't understand is, how does this sort of big, gigantic, how does this big short in the shares get covered without buying more silver?
Well, that's the part where under the short selling rules, you're allowed up to, I think, 30 days or so to, if you have a fail to deliver, for example, and this is where a lot of this came from on the posts that I just put under my account. The fails to deliver in October were extraordinary. I mean, it had never been seen in that silver ETF that I know of. I mean, it's very historic. I not only wrote about it. You're going to have one-day events with a fail to deliver and a spike, and then it settles back down. But what I started following, and was one of the first to actually really notice this, was the borrowing fees to short shares. I watched that very closely. And that started to rise through the summer and crescendoed in October. And the annual fee rate to borrow SLV shares was up to about 20%, which is enormous. I mean, usually this thing is at 0.3, 0.4% on an annualized basis. So this thing got extremely tight, and there were days that were absolutely no shares available to borrow. And I was posting this stuff every single day, literally. If you go back on my account feed, it's like a diary of what I expected silver to do and what was actually happening that that made me think why was things happening and how were they happening. I was basically just writing it all out on a day-to-day basis.
Yeah.
It's where this thing starts to tie in with short selling is if you can meet demand by naked short selling and then potentially settling those trades, the following days. That demand all of a sudden is it's kind of like a fire truck going up to a house that's on fire and dumping water on it with a fire hose. You're putting out that sort of pressure or that blaze, and that blaze, think of it as call buying, or think of it as buying interest for silver because silver's running up, and all of a sudden, in this market, you get momentum traders jumping on the trade, and more money. A good performing asset attracts more money, and as that asset performs even better, it attracts more money, and so you get this crescendo. Well, in order to try to put that out, you can meet that demand by just naked shorting shares if you wanted to. And then all of a sudden, you're not actually having to go to the authorized participant saying, listen, we need to create shares right now because I'm short on my books, whatever amount of shares. They can just hold off on share creation, which means that share creation doesn't need to put demand on physical silver. And all of a sudden, you can kind of put the fire out a little bit. And if you look at London during this whole time, London's market was very tight on silver. Lease rates were spiking, financing costs were going up. You had this huge backwardation in the futures markets in New York to the London spot price, meaning it was about at some point it was like $2.50 under $2.50 under spot, meaning the lead month futures contract, which has never been. I've never seen that before. That much of a backwardation, especially with interest rates at 4% or so. And so it was showing a great degree of tightness. Basically, metal was in the wrong location, and it was in New York instead of in London. And I can go through why that happened.
JD, can you help me with this? Do we need to be conspiratorial about what is going on with the silver ETF and the creation of the shares and not having to deliver physical silver? Or is this just the dynamic that we're left with and just deal with it? You know what I mean? Like, I don't know how to look at it. There's all these conspiracy theories about the huge naked short at JP Morgan and things like that. How do we look at this ETF short creation without having to deliver silver?
No, I mean, when I was at Lehman in 2005, there was this guy from the World Gold Council that came to the firm and spoke with me and said he was starting a gold ETF, a physical gold ETF. Mm-hmm. And he wanted Lehman to be an authorized participant, right? Mm-hmm. So now, look, this is 20 years ago, but I sat down with that AP agreement, and it was about 150 pages, and I went through it with a fine-tooth comb, and I'm like, this is bulletproof. Like, this is, I had to get comfortable with it in order to sign up Lehman as an AP, and yeah, there's no conspiracies here. No.
Okay. No, that's all I wanted to hear. I'm just trying to figure out where that overlap is. You know what I mean? Like, we just went through this situation where silver clearly rallied because there was so much.
Having said that, there is a possibility at some point in the future that either GLD or SLV or any of the other ETFs, where you have a divergence between the ETF and spot for some of the reasons that Bob is talking about, right? Like, it is possible that you could have that divergence and people say, hey, like, the ETF is up 1%, but spot is up 3%. Why is that happening? Like, that could possibly happen. So
I understand.
Yeah. And just to give you clarification, anyone who follows me, I'm not a conspiratorial type of guy when it comes to this stuff. I try to be extremely level-headed. There's a lot of sort of garbage, you could say, that's put out by the retail precious metals dealer and promoter industry, which drives me crazy.
Totally.
And it's unfortunate because it detracts a lot of investors from the actual metal, because it's like, well, this is just a bunch of snake oil salesmen trying to sell me a high price premium product. What I try to do is, and I've read these authorized participant agreements, so sales agreements. I've read the SLV prospectus. I read a lot of stuff, and so I try to take in this information. So my posts, and I get into a lot of these sort of Twitter or X battles with people that are, precious metal pro precious metal investors that are saying, hey, listen, your head's in the sand. This whole thing is rigged. The whole system is rigged. I mean, at the end of the day, it has to be to maintain the debt structure, all this type of stuff. It's just we're working within a system that is, has its own rules, and those rules tend to bend, unfortunately. And so, but to me, it's understanding how the system works and trying to work within it. It's just, I kind of tell people it's like going into a casino. We're still not going to not gamble if we walk into the casino. There's still a lot of interesting bets that you can make, but that the probabilities are against you, but yet you still go into it. Well, the markets are very similar in structure. So the idea, what SLV represents, it's a great trading vehicle from a standpoint. Hey, listen, you have very, very small transactional costs, unlike physical metal. You can get in and out of a position. You can create structure, paper structured products and strategies off of using that combined with options. Yes, you can do all that kind of stuff. But at the end of the day, there are true risks with these ETFs that I also get into. Like, for example, SLV, and this is true with every stock that's held in a brokerage account. You're not the legal owner of it. Right. You're only a beneficial owner. The owner of every stock out there is Seed & Company, which is an LP of DTCC. That's an actual fact. And it even says that right in the prospectus. SLV, for example, most people don't know this, but if the authorized participants, if a few of them got together and said, listen, if I have a 75% ownership in the or 75% of the shares outstanding, I can actually shut down that ETF and close it down if I wanted to, which could put investors at risk that own it, because they could shut it down at a period of time where it's at maybe a big discount to the net asset value of the fund. Because remember, if it's at a big discount, they can take in those shares and then redeem those shares for the physical metal, which is at a higher price, and pocket that difference. That's how these authorized participants work. And this is where I tell people, when you're invested in ETFs, if you're a long-term owner, you're not investing in the product, you are the product, because the ETFs make money on the cash flow and capital flows that are going in and out of that fund. They make the arbitrage between the discounts and premiums and so forth.
Yep. Let's talk about the physical market just a little bit before we dive off into the broader markets. It looks like we're at another year of like 1.2 billion ounces of silver demand against about 1 billion ounces of supply. So we've got a 200 million ounce deficit thereabouts. The deficit is now at an 11-year high, I believe. What are your thoughts? I mean, does this obviously translate into the direction that we're going, into silver breaking out above 50 and then getting comfortable at much higher prices? Is that your view, or do you not necessarily think the price has to go up much from here?
No, my view is, I think, it's a combination of things. But yes, when you see these deficits building and so forth, again, people around the world watch us. This is not a U.S.-centric story, even though in the U.S., for silver, specifically for silver industry use, we import about 330 million ounces a year just for industry usage, not even taking into account investment demand. And this idea of putting tariffs, people, USGS or U.S. government just announced that silver is now on the critical metals list. That's the first time that's ever happened. It's a recognition of how tight, in terms of the supply, is out there relative to the usage of that metal that's critical in industry. So these are all recognitions that are actually going around the world. I mean, people are realizing, hey, listen, the money printing, you got the currency devaluation and debasement trade, and you got all these types of things that fiscal deficits, and we have to inflate or die, basically. We can't afford to have a market go down, because it would not only hit tax flow or tax revenue base, but also would crimp collateralization values and so forth. It's a rabbit
Tangled
hole
web,
of
yeah.
yeah. It's a mess, and so but it's happening around the world, and I think institutional investors, retail investors, high net worth investors, they're recognizing this stuff, since COVID, where they're saying, hey, listen, I got to protect, maybe a portion of my portfolio with something that's held outside the system, something that has, been tested over, a period of 5,000 years. You have to remember, gold and silver has outlasted every civilization, empire, since the beginning of time. Money doesn't, paper money doesn't last forever. And so it's recognition that, I may just give this stuff to my kids or my grandkids, but at least I have something as an insurance policy to protect myself against, potential devaluation of currencies and things like that. Or what's happening now is political uncertainty. You're having as the White House makes, since the beginning of this year, a lot of these remarks about tariffs and trade policy and so forth, that has made a lot of people jittery. And obviously people are watching the Federal Reserve. They're worried about the independence of the Federal Reserve. And that has promoted a lot of the big banks to recommend gold and silver to their clients because of that potential issue of recognition by the investment community. It says, well, wait a second. If the Fed now is politicized, this is like the 1970s all over again.
Yeah, it really could be, man, right? JD, what are you thinking?
I'm thinking we move on to the markets.
Yeah, I'm going to ask you one question before we move on to the broader markets. Is silver a base metal or a precious metal now, Bob?
I've always looked at it as a precious metal, more on the monetary side. Yes, 75% of the usage of silver is for industry usage.
So that's why I kind of call it a cross or a hybrid, if you will, but I can get away with that. So in the broader markets, JD, call up there's no triple top guys and tell them they're out of business, because there's a triple top in Bitcoin at 123 to 126K, and it is currently heaving below 90K, dismantling the entire risk complex on us. What do you think of the broader markets?
Well, we got Nvidia earnings today. I mean, this is going to come out tomorrow, but stocks ripped on the open, kind of faltering a little bit. I tell you what, we got support in the S&P. Where is support?
The 200-day moving average, below the 100-day?
Yeah, I mean, if Nvidia earnings miss and we break below support, like it's lights out, I think.
You know what I think is worse lights out? If Nvidia beats and the stock breaks down below support, because the end of a bull market is when stocks start going down on good news.
Yeah.
So you got to watch this earnings report today, listen to the conference call, and watch price action like a hawk. Because in my opinion, there's like three scenarios that can happen. We can have, in two scenarios, Nvidia goes south. In one scenario, it drags down the entire tape and we have some period of agnostic selling. In another scenario, Nvidia is sort of ring-fenced to semis and tech a little bit, and we see a flow into the commodity space, which I feel is teed up like a dirt cheap beach ball. Whether you look at the BCOM or if you look at the pullback in industrial metals or gold miners, within trend, this stuff is set up to be bought. And then there's a third scenario where maybe they beat and the stock rallies. The 100-day moving average in the S&P holds here around 6,600 and we bounce towards the highs. So I think those are the three scenarios that I'm looking for, all of which seem totally possible to me. Unless you guys want to throw darts at any of them, please do.
Yeah, I would go with that. There was something else. I remember what it was. I saw a tweet from Bespoke, Bespoke Invest. Bespoke is great. They do great work.
Great work.
And they put out a chart of 6, I would call them rare earths or nuclear or all the speculative stuff that we were talking about a couple of months ago. And all of these charts ripped. Yeah.
Which hats? Which hats?
Right? Dude, like when you see stuff like that, like that's,
It's not good. It's not good. Like, part of the uranium trade is looking like it could do a little bit of a round trip. It looks like we're facing the leaders of the year are getting tested right now at support levels. Gold miners, industrial miners, and aerospace and defense have been and uranium miners. Those four sectors have been way out in front. They're all pulling right back to their 100 days, give or take, same as the S&P. So a lot is hanging on Nvidia after the close today, for sure. And I think a lot is still hanging on Bitcoin. I think Bitcoin can trade down to 80K or so and still be in a bull market, just kind of have a little bit of a different complexion. And I think that once that bleeding stops, then the S&P bull market will resume, but not until Bitcoin finds a bottom. It's just too much of the asterisk on the risk-off scene right now. So
we also have payrolls on Friday.
Are payrolls Thursday or Friday? Non-farms are Friday. Wait a minute. We got to look at this up.
Just take a look.
Let's take a look to be sure. Today is the 19th, Wednesday. On the 20th, we are getting initial claims. That's tomorrow. That's
claims.
Initial claims, right? But we're also getting change in non-farm payrolls. Unemployment rate is coming out tomorrow.
Tomorrow. Okay.
11/20. That's tomorrow, right? So This will be out when this podcast is released. And then if you look at the Bloomberg, it looks like they've got a set of delayed reaction data from when the government was shut down that looks like it may be coming out. And I can't really tell if it's coming out on Thursday or Friday or not, but there's a list of data there that we have not disseminated that looks like it may be dispersed. So
we're expecting 54,000 for payrolls, which is very low.
Nice low bar, yeah.
Yeah.
Well, we'll see what happens with that. I mean, I'm not a believer that the economy is curling over. I'm just a believer that we are going to get interest rates lower because Trump is demanding it. So I guess that's a good wrap. If we go around the markets, I mean, that I think we kind of postured them properly there. A lot of it counts on Nvidia tonight. So, Bob, out in Idaho, what are you doing when you're not stacking precious metals safely and insured capacity in vaults all over the place? What are your off-market things to do?
Well, we're one of the only depositories in the country that's also
depositories again.
Yeah, a federal firearms licensed dealer. So we get involved with night vision, thermal imaging. The gear that we use is, it's not the stuff you buy from Dick's Sporting Goods.
What do we get involved in?
Night vision, thermal imaging. We do a lot of different types of stuff. We run a multiple caliber of different rifles for different situations, whether we're running moving items in the truck, so to speak, or versus what we have here at the depository, sort of on our hip. So it's a lot of shooting, that kind of stuff. So people like the guns and gear. We actually sell that as well. So.
Oh wow! So is there like a SWAT security side to your business because of the physical nature of being in the metals business?
There's a lot of training that we do. And so you kind of have to, hopefully we never have to use this stuff, but at the same time, it's something that's important to just the day-to-day operations of our company. So it's, and just for people that aren't aware, we're the only depository, I think, in the world that's actually a family business. So everybody who works for me are my kids. And I don't want to say kids because it makes them seem like they're 15 years old. They're in their 20s and 30s. So it's very unique. A lot of high net worth individuals love that because they know not only is the information safe, the metals are safe. We're tied to the client's hip in terms of their interests are our interests. We're not like these big companies that say, hey, listen, it's our way or the highway. So a lot more flexibility. So it's from that perspective, we offer a lot different type of service and relationship.
Where does somebody get all the information they need to get on your fund? It sounds really interesting, and I'm definitely going to kick the tires on it just to see what the presentation looks like.
Sure. Goldsilvervault.com is our website, and there is actually under investments, I think it is, there's a web page that gives you a 1 or 2 page executive summary, that type of thing. The fund's up about 60+% this year. Again, that's
right in line with metals performance.
Exactly. Yeah. And so I didn't hedge. A lot of people after April's sell-off got kind of bearish on the metals and literally missed a lot of the move on the way up. So it hasn't been as easy for even a lot of experts out there. But by looking at sort of the long-term picture, the advantage of holding physical is you just can't easily hit the mouse click button and hit the sell button and dump your position. So it forces you to be much more longer term oriented. And that allows you to look at the fundamentals. Yes, I look at technicals and I look at a lot of the market structure, understanding, the flow, where the physical buying is coming from, as well as looking at, commitment of traders reports and trying to understand, the commercials versus speculators and so forth and manage money. All those things you throw into a big melting pot and you put the analysis in there and you try to figure out, okay, what's actually happening here. And that's what I do. It's not just simply looking at one thing.
I totally understand. And I have to point out to people that this is what happens when you discuss a topic that somebody is completely dedicated to and obsessed with. We try to go off markets and we wind up right back on the markets. You know what I mean? And I think it's a really good, healthy sign. I'm really, really interested in learning more about your fund, Bob. It sounds like, a great one-stop destination to have physical insured metals exposure. And I like that very much. And I would imagine that you might be gaining in popularity over the next several years with $180 million in assets now. I could see that growing substantially. So we are going to end this podcast now. Before our send-off, I want to mention the TG Macro Conference has officially signed Grant Williams to appear in February. We have 2 more super guests to announce on December 1st, and the price is going to go up on that day to $1,250. Make sure you get your early bird ticket now. Do you have any final words, JD?
Silver's going to 200.
Silver's going to 200. That's how we're ending this podcast?
Yeah, that's how we're ending it. Yeah.
I love it, dude. We can end it right on that. Silver to 200, bull market in precious metals, a specialist right here in Bob Coleman that everyone should be following, if not investing in. And we'll see you next week on Macro Dirt 74. Hasta la pasta, good people.